2:01 p.m. Will the secretary please call the roll?
Yes. Jeff Hill,
Yes.
Jim Bond,
Here.
Sky Herrick is absent, Rob Foltz.
Here.
All right. Got a quorum.
Okay. Oral communications. This portion of this agenda is reserved for oral communications by the public for items which are not on the agenda. Understand that California law limits what the board can do regarding issues raised during oral communications. No action or discussion may occur on issues outside of those already listed on today's agenda. Any person may address the committee at this time on any subject that lies within the jurisdiction of the district. Normally, presentations must not exceed 5 minutes in length, and individuals may only speak once during oral communications. Any director may request that the matter be placed on a future agenda, or staff may be directed to provide a brief response. Mr. Holloway.
Hi, my name is Bruce Holloway from Boulder Creek. I just had a question about the bill list that was on the board agenda, in the agenda packet last week. There are payments to CalPERS, and there are annotations there. And one of the annotations was CalPERS underbar WTP. So I'd like to understand what that stands for. Well, WTP sounds like water treatment plant, but I kind of doubt it would say CalPERS water treatment plant. So if anyone can tell me what CalPERS WTP means, thank you.
So I would ask staff to respond to Mr. Holloway on that. I don't think any of us at the table here know off the top of our head what that abbreviation is on the invoice list.
CalPERS WTP.
Yes.
I'd have to check with someone in finance.
If you could check with finance and then please.
See one on the screen.
Yes. Can we get finance to comment on that?
I believe you're referring to me. This is Heather Ipoletti, the interim finance director, RGS consultant. I am not familiar with that abbreviation. I will get back to this committee and the board with that information.
Thank you very much. We'll get back to you, Mr. Holloway. Any other oral communications? Seeing none. New business. The first item on new business is election of the committee chair. By board policy, the committee chair can only be a member of the board of directors, and the only two present are Bob and me. And so if somebody would care to, Bob?
Yeah, I'll nominate you for chair.
Okay, thank you.
That would be Jeff Hill is nominated.
So Bob has nominated me. Bob was previously asked me not to nominate him.
I'll second the nomination.
Second. Okay.
Would the secretary call a vote?
Jim Bond,
Yes.
Rob Foltz,
Yes.
Jeff Hill.
Yes. Thank you.
Thank you.
Okay, the second item on the new business agenda is 2024 water revenue certificates of participation. Discussion about proposed 2024 water certificates of participation. Would staff care to bring us up to date on that and lead the discussion, please?
Absolutely. Thank you, Chair. So I'm going to turn this over to Heather and the finance team. So Heather, I don't know if you would like to say a few words beforehand and perhaps introduce our guest, and we'll take it from there.
Yes, thank you, interim general manager. Good afternoon, committee. Heather Ipoletti, interim finance director, RGS consultant. The action before you this afternoon is to recommend that the interim general manager place the proposed debt issuance on the August 1st board agenda for approval. And as a way of background for anybody in the audience or listening online, I'm going to go through a couple of items that give you a little bit of background about why we are proposing to issue this debt. The adopted water utility financial plan model used to develop the updated rates included a 5-year cash flow projection through June 30th of 28. The financial plan model assumed the district would issue 19 million in debt financing in fiscal year 23-24 to fund capital projects. The 23-25 biennial budget assumed receipt of just over 16.3 million in FEMA reimbursements. A revised estimate estimates the district will receive 7.5 million during the 24-month budget period, creating an 8.8 million revenue shortfall. As of May 31, 24, there was 4.4 million in unspent debt proceeds from debt issued in 19 and 21. Staff anticipates the unspent debt proceeds will be depleted by the end of July or early August, waiting on a couple projects, something about a gravel pit or something that's been closed, and we're trying to complete some projects that will be paid with that remaining debt proceeds. For FEMA funded projects, it's important to know that the district must initially cover the costs for the entire project and then seek reimbursement upon completion. The district's reserves are insufficient to cover these expenses for the FEMA projects. The timing is also crucial to protecting the ability to receive other important grant funds. As approved at the July 18th meeting, an estimated 1.4 million in additional funding is needed to advance the first phase of the Bracken Brae Forest Springs consolidation and fully utilize the DWR grant. The grant funding agency has provisionally given a deadline extension to June of 25 to allow the project to progress, but meeting this deadline will require that the funds to complete the project are available by the end of August or early September. With the filing of the voter initiative, the district's capacity to support an additional debt issue has been reduced to 12 million. At the June 6th board meeting, the board approved the selection of a very experienced financing team to provide the necessary guidance and expertise to move forward on the proposed process. Final board review and approval is still required, currently projected for August 1. And that will be to approve the issuance of the bonds and all of the required documentation to complete the financing. With that background, I'd like to turn the presentation over to Ken Deeker, fiscal advisor from Del Rio Advisors, who is here this afternoon to present the details of the proposed issue and to answer questions. And Scott, can you please bring up his PowerPoint? Thank you.
It's got to be go to page 7 when you bring it up. Okay. Thank you. Thank you. One back. All right, good afternoon, board members. My name is Ken Deeker with Del Rio Advisors, a municipal advisor to the district for this particular financing. I want to talk a little bit about the specifics of the financing that we're proposing. Right now, based on recent numbers, the estimated principal amount of the bonds is about 11.7 million. That will provide a project fund of approximately 12 million. And you might want to ask, why is the principal amount actually less than the project fund? That's because in this marketplace, fund managers in particular like to buy premium bonds. So they may be a 5% coupon at a 3.5% yield that generates a premium to the district, keeps the issue size down. All of that money goes into the project fund from the premium. Estimated cost of issuance is about $409,000. That includes cost of issuance of $200,000 for the legal team, my fee, other fees of the financing team, disclosure counsel, bond counsel. Also includes the cost of the underwriter to underwrite the bond. That's about $96,000. And then the balance of the fees, $100 and some thousand are related to bond insurance and surety premium. Now I'll explain what that is. We do not know where the district's rating is going to fall based upon this proposed initiative that's going to the ballot. And so what we're doing is we're assuming that you would fall in like the A-rated category. for S&P. S&P provides a rating anywhere from AAA being the gilded credit, the best credit there is, AA like the U.S. government, single A. A lot of water districts fall into that particular category, but again, depends upon a lot of economic factors, managerial factors, everything they consider in their rating. If you were to secure a AA rating by some chance, we would not pursue the bond insurance because the bond insurers are rated AA. So the concept here is that if you do come in with an A rating on the bonds, we would pay for the insurance only if the insurance to bring the rating to AA is more, the cost of that insurance is more than offset by the lower interest rates that the market would bear when we would actually go to market. Total interest is about 14 million. Total debt service is 26.4 million. I'll talk about the wraparound existing debt service in just a moment. It is a 30-year bond, has a true interest cost of 4.65% and an all-in cost, which includes all your cost of issuance, including the insurance and everything else, is under 5% at 4.83. Next slide, please. What we also have to do is take into consideration existing obligations districts entered into over the years. You got the 2009 Felton loan, you have a 2014 SRF loan with the state, you have a Capital One loan with Capital One Bank, and you have some 2019 COPs that were sold publicly, and then a bank loan with CoBank from 2021. The concept here is we are trying to keep your debt service coverage within the minimum 1.25 times. That's the requirement under your legal covenants. And so what we're doing is we're wrapping the debt service around. So if I can point out here, people online won't be able to see this, but it doesn't work on the TV, I don't think either. Yeah, it doesn't work on the TV, no problem. So what I'll do is I'll just walk over here quickly. What we're doing is we're paying some interest only during the years in which your existing obligations are maturing, and then we start to amortize principal. The idea here is that as these obligations pay off, you have additional capacity to borrow for other CIP projects many years down the road. If we were to shorten the term of the bonds to a shorter term, your amortization would go up and you would blow your coverage in the early years. So we're trying to keep the coverage satisfactory to meet your legal covenants. Next slide. I've also graphed, this is the projected debt service coverage based upon 2024 year-end results, based upon projected 25 through 29 results, based upon the rate study numbers, adjusted for a successful overturn of the fixed charges in the ballot initiative. The impact of that is it's brought your bonding capacity down from approximately the 19 million that was estimated in the rate study to the approximately 12 million that we're proposing today. And as you can see, in fiscal year 26, the debt service coverage hits a low of about 1.3 times and then slowly grows up as the rest of the rates are implemented. So again, the damage to this is the fact that the rate initiative that's going before the ballot has reduced the bonding capacity of the district. So you're going to have to prioritize your CIP because you won't be able to fund it all, at least not right now. Next slide. What I did is just graph it so you can kind of see what the shaping looks like. As you can see here, I've taken the debt service here and we've wrapped it around the existing debt. The idea here is to try to keep this as level as possible during the years in which your rate increases are being implemented. As you can see, based upon that, the best that we can do is about 1.3 times coverage, 1.32. So you do have a pinch point, and again, that will determine what happens in November, and then what happens on future rate increases down the road, whether or not you can do additional bonding for the rest of your CIP. Next slide. So basically, these are the next steps. These dates are slightly off a week because we postponed the Budget and Finance Committee meeting from last week till today. Today is the board agenda deadline. All of the legal documents, the official statement, the preliminary official statement, all those documents are posted to the agenda for the August 1st meeting. And again, those can be pulled, but this is the conversation we wanted to have today with this committee, is to try to move this forward. August 1st, if the board approves the financing, it does not need to come back to the board after August 1st. We are planning on August 5th, August 3rd or 2nd, to go to S&P for a formal rating. We're putting together the rating presentation now. Again, the district will not incur any expenses for this financing until the board approves it. So basically, everybody's working contingent on the financing right now. The only cost that we would incur, which is non-contingent, would be approximately $25,000 to $30,000 for the rating fee. But if the board doesn't approve on August 1st, we'll pull back the rating and not go through that process. Receive the rating. Week after that, and then plan to price the bonds third week of August and close by the end of the month in order to help secure that grant funding and keep the projects going. So with that, I'm happy to answer any questions related to the COPs.
Jim? Any,
Would
well,
like
the
to go
committee
first.
have questions? Jim,
I have questions.
go ahead.
So first of all, the caveat is these are all out of respect. I respect all the work everyone's doing, but I'm confused. I've tried to look at it. I see that we want to borrow 12 million. I get that. And I have in front of me, I have a capital fund cash flow. And separately, I have a sheet that talks about the CIP funding sources and estimate to close, I think, for this year. What I don't have is any assurance that if we borrow money, we have the capability of spending it. In fact, what I suspect we're about to do is borrow a bunch of money, let it sit in the bank, pay it as a ratepayer. I'm going to be writing checks, and that's going to go into a fund to pay off a loan. That's not going to do me any good. It's not, from what I can tell, there's no connection to what we want to borrow and what we can spend. Now, if we have that plan, I would love to see it, but I don't see that plan anywhere.
I think that's actually probably more of a functional question for the organization. So I can assure you, we are coming to the end of our ability to fund any of the project pipeline that we do have, but it's a train that's moving pretty fast, and the fuel is money. And so we're certainly capable of spending this money, and we'll be spending it.
So
Maybe I'm not understanding your.
okay, so if I look in the past, it appears as though we borrowed money and then we were unable to spend the money. And I guess and I could be wrong, but if you can point out how I was wrong. But if that's true, then I would have to ask how we're able to spend all this new bucket of money when we couldn't spend in a timely manner the old bucket of money. And if we don't have concrete plans to spend everything, why don't we just find another solution, get a line of credit and borrow against that? If we have a plan to take the money that's cut, like I do it in my home budget, the money comes in and I'm going to then spend it, and I know when I'm going to spend it year by year, and I don't see that here. You say that we can spend it. I don't have any assurance that we can.
So perhaps we're too linearly focused on the actual financing piece, but we did bring yesterday to the Engineering and Environmental Committee a project priority list. But even if you looked at the CIP list that we have in our budget, was it the 23-24 budget? We have that CIPs, and like I say, we're heavily in the process of implementing all these projects, and they're at different places in the timeline versus whether we're design, bidding, etc. But we're certainly in the throes of that, and that's been ongoing. So it's not something, probably we're not bringing it to the committee or board because I guess it was implicit that we are implementing. What we found is financially, and Heather can attest to our finances, and she just presented, and it's also in the memo, is we're finding that we're not going to be able to fund the projects that we have. So it's not a case of not having the machine, it's not having the fuel, which is the money to run.
May I add just a little bit to that?
Thank you, Heather.
Heather, if you could wait just a moment, Director Fultz.
Well, I mean, just to back that up, Jim, because I was on the board at the time we took out the previous COP and the 2021 bank loan. And it took about 1.5 years to really get to where we were kind of ready to start doing construction. That is, there was a lot of design work. Now, in that case there, we were starting from ground zero, but we had a staff, and it just takes a while. So one of the things, and I'll get to this a little bit later, but I have some other information, I think, would help us understand exactly where we are, or like to have that information to understand exactly where we are in that. But, and even in 2021 loan, it took us, and that was in the middle of COVID, obviously, but it took a couple of years to actually get going. So I'm concerned, as you are, of taking loans out and starting to make payments on those without actually having a very tight relationship between taking the loan out and when you actually start putting stuff in the ground.
Yeah.
Okay, Heather?
Yeah, I agree. I understand your concern, and going back on the use of the bond proceeds prior to at least this fiscal year, since I've gotten involved in October, I would agree with your concern and the slow use of the proceeds. But I can say that just in this current fiscal year, with the projects that the district has been doing, that they have gone through as of May 31st, those are the numbers that have been reconciled as of right now that I have to present. The district has spent 11.5 million just in the last 11 months of the bond proceeds that were unspent. So, and I do have to say, is based on the information that I presented, the FEMA shortfall, the spending down of the existing proceeds, and the lack of reserves that the district has, and the history of the natural disasters that have also slowed down the use of the proceeds and unable to continue with projects, that unfortunately, if the district is not able to approve the bond funding on August 1, and the board decides not to go with this debt financing, essentially the capital improvement program has to stop, because there are insufficient funds to support a capital improvement program going forward without this debt financing.
Director Fultz?
During the rate study process, I asked for a fairly detailed cash flow analysis. Monthly would be ideal, quarterly would have been acceptable, to be able to demonstrate what our cash needs were relative to both operations and what kind of efficiencies we could achieve in operations, as well as capital, project specific. That cash flow statement was never produced. I am once again asking for that fairly detailed cash flow statement so that we can see exactly what our cash requirements are relative to where these projects are in their design, bid, build phase. The fact that we spent $11 million in capital this year is a red herring, in my opinion, because that is for projects that took a couple years to get through the design process, the bid process, and waiting for the materials, because at one point in time, ductile iron lead times were like almost a year, right?
Actually, more like 18 months.
Yeah, I mean, it was horrendous, not so much anymore. So what happened is everything got jammed into 1 year. That's not the way, obviously, that you want to run this. You want to have a fairly steady X number of million every year, which my figures show should be around 5 million a year or so in projects. But without that cash flow analysis, without the projects listed as to where they are and what cash is actually needed, I mean, I'm assuming you guys have done that work. I think it's just something that should be shared, certainly with the committee, and obviously with the board, should it get to the board level. I have other questions, but I want to make sure everybody else.
I'll just stop. Thank you. That's kind of what I'm better than the way I put it. I just had one question, just as an aside. It looks like we are prepared to spend 24 million in capital projects this fiscal year. So I'll just ask Brian or anyone, does that seem reasonable? Are we going to be able to spend it? Do we have projects that'll take that 24 million?
We don't have, well, we have, what we're talking about is $12 million worth of financing. So regardless, we're not going to be able to, well, depends on that. Hey, President, if I may, is it okay if I answer the question?
Yes, please.
Thank you. I would like to answer the questions for the district. Thank you. So admittedly, we're leveraging grant money, et cetera. So, yesterday, what we did is we went through the CIP list and we have, based on the feedback there, we will take that list and look at how much of it's grant funded, how much of it's actual district funded, and we'll tally it up. But in other words, it's like we'll have $12 million basically of money for CIPs. And I don't know what that total is going to be, but let's say it is 20, 25 million. I'm guessing that we can get through easily, we can get through $12 million again, based on our last year's track record of being able to go through that. Because one thing is we're not wrapping up, we're in full stream mode. So all of these projects are already got timelines going, they're already in full bore, going full steam ahead. What you're gonna do is your refrigerator's running right now. If you wanna not fund this, then yank the cord. And what I'd like to do is also redirect this conversation, if I may, to not whether we have the machine, because I'm saying, yes, we do, is ask the specifics about the financing, whether we feel that it's, any details about how we're going about the financing. I think we have an expert here, and I'd really like to reframe the conversation and direct it towards it. Thank you.
Okay. Director Fultz.
But the need for the financing really does come down to what our pipeline currently is. And so you can't have a conversation about one without the other unless you're accepting the fact that you need it. I don't, excuse me, I don't know that I'm there yet without seeing that detailed cash flow that I'd asked for months ago that unfortunately never was delivered. It's a shame, but I think that kind of transparency would help me, would probably help the community as well. With respect to our ability to even do 12 million, our history on that is variable. So in the past, we've been able to sustain about 5 or 6 million a year, depending on where the projects were in their design phase versus construction, et cetera. To say that we can do 12 million next year based on 11 million this year sort of doesn't address the specific issue that although that $11 million that was spent this year was a result of a couple of years of design in front of it, for better or worse. I'm not saying it can't happen. I'm just saying I haven't seen it yet. I haven't seen the list. I haven't seen where we are. I haven't seen where in the design process we are with these things. So I'm just skeptical, but I certainly admit that it could be done.
So I would comment that at yesterday's engineering committee meeting, we were presented with a list of projects. The engineering committee requested that some of them be shifted in priority. And we also requested that in addition to the total amount of what the project would be, we wanted to look at, particularly for FEMA projects. Okay, so on a FEMA project, we spend the money, then they send the money back eventually, some percentage of it, presumably 75 or 90%, but that's 75 or 90% of what they have approved, which may not be what we ended up having to spend. And we wanted to see, okay, so then we get $5 million back from FEMA, where does that go in? And so we requested from staff that they attack that list and give us essentially more columns of okay, this is what we think it'll cost, this is what we think we'll get from FEMA, this is when we think we'll get it from FEMA, so that we can see a cash flow impact from the FEMA projects.
That makes perfect sense, because you'd want to take that money you get back from FEMA and put it into other capital projects, one-time money. You don't want to spend it on operations, right?
Yes.
So, no,
what we were looking for was
I get that.
Okay, at least quarter by quarter or half by half.
Sure.
When are we expecting to finish this project, when do we think we'll get reimbursed? When will we have money coming back from FEMA? That big, $3 million check or whatever.
A long-term plan.
Yes.
Now, in the, I don't want to dwell on this, but in the 2021 water master plan we did, there were $75 million worth of projects identified as priority that needed to take place over the course of about 5 to 8 years. Was any of that part of the conversation yesterday as to how all of this stacks up?
Not directly. We did not go back and look at old plans.
Okay, all right.
So I'm sure that a number of the projects that we discussed yesterday were indeed on that old plan, but we didn't go back and say, oh, this has been on the plan for 4 years. This has been on the plan for 8 years.
Okay. Now, I do have some questions regarding the financing directly, but I see Brian has his hand up.
Brian, please.
So I do want to point out that, and Ken's here, you can confirm the whole CIP project list. We did reprioritize somewhat, not very much, but we just put the main projects that we want to complete in the next year up at the top. But unlike our past financing, this financing, we are not beholden to the project list as presented. We can even add projects to the list where we're not locked in like we were with the other financing. So I think that's important to point out for both public and this committee, and also we pointed out to the board. So we're not locked into these projects in any way.
That is correct. You're not.
Yes.
It's water projects, and there's a whole series and they can be interchanged with different projects depending on prioritization. We also know that
Jim,
takes a while to bid different projects and for those costs to come back in, and so we understand the timing of that.
Jim.
So just a couple follow-ups. So Brian, I get your question. We've got Ken here, we got Heather, we got you. We probably should be talking about the actual bond and the financing. I from my perspective, I looked at it, I listened to your presentation, I studied it, read it 3 times. I think I understand it, and if we need to borrow the money, it seems like a good process. Seems like it's fair, and Del Rio's done the right stuff. And I apologize for dragging you into my other concerns. And I just want to make a note, and then I'll turn the floor over. Is it looks like after we plan to spend 24 million on capital this year, that we're planning on doing about 14 every year. That's what the capital fund cash flow says, and that's a lot more than what you said we've been spending.
Yeah.
Okay, I just make an observation.
Yeah.
That's it.
Bob?
So a number of questions came to mind. One is we're about 3 months away from the election. Just statistically speaking, these kinds of elections have a variable success rate, even though I'm in favor of it. Why would we not wait until that election to be able to then say, we are not, let's say it fails, and we're back to the rate increase as it was. Why the rush and not wait for that election to be done? Literally, we're 3.5 months away.
So it's my understanding, and Heather can jump in here as well, it's my understanding that there's $2.5 million of grant funding that requires the matching funding from the bonds, and that was the reason for pushing this forward. Also, we want to avoid selling the bonds around election time because it's going to be extremely volatile. So, the last that we could probably sell these bonds would be October, but then I think you miss your deadline of being able to match the grant funding. That was our biggest concern. Heather, is that correct?
That's correct. In part, and well, in full, but there's another component. Literally, Garrett, the project engineer, or I think he's called the project manager or engineering manager. He's in the process of lining up bids in the middle of design for certain projects. If these bonds are not able to be able to move forward at this point, literally, I have to have a very conversation with our interim district manager about any CIP work being done. Because as it is, we won't be meeting our reserve policy if we move forward with any project. So it really is these bonds really are the reason that will keep the CIPs moving forward, the ones that Garrett is in the process of working on.
Well,
Mr.
I,
Foltz.
yeah, I understand that need for cash, but there are many ways of being able to achieve cash flow. Was there any consideration given to effectively a bridge loan or a construction loan or a bank loan of 3 to 6 months, basically to cover the cash needs we have, wait for the election to happen, and then go back into the marketplace? It doesn't take a long time, apparently, to get these.
Those were not in our discussion.
Well, I mean, we did, like I say, there's multiple ways of handling cash flow issues. There's short-term debt, long-term debt. There's these COPs, which when I was on board, we did them the first time. As a result of those, I wasn't a fan of them. That's why the bank loan was more interesting as the second financing. I'm kind of curious as to, was there any other consideration around bank loan, both short-term and long-term? And do the same thing we did with CoBank.
Thank you. Ken, I know that when you and Nikki looked at numbers, you looked at that option as the other, I'm going to call them private placement loans. Do you remember what the reason was that the COPs were what was recommended?
So there's a couple things going on here. One, the bank loans these days, most banks will go no longer than 15 years. So you're talking about borrowing $12 million amortized over 15 years. There's maybe one bank that might go 20 if they approve the credit. It's a much different environment than it was back, say, in 2019, even 2021, right? We're in a much higher interest rate environment. A lot of the banks have pulled out of public finance. They've moved on to other things or closed their departments altogether. So the problem with it is the shorter amortization. And given the potential reduction in rates, this is all that we can support. And we needed to amortize it over 30 years, try to keep the debt service as low as possible, as level as possible to maintain coverage. A short-term financing is clearly an option if you need to short-term finance something. I've done it multiple times when we've secured WIFIA funding through the EPA, where we'll do the short-term funding to fund the project, and then the WIFIA comes in at the end and they reimburse the notes that were sold. A lot of the commercial banks have pulled out of municipal finance. So you could probably secure a line of credit or do a short-term note, but you're still going to pay interest on those dollars. And then you have to take the note out with long-term financing. It's not going to stay there forever and roll over. So either way, you're going to be paying it. The reason we did it this way is because, one, it's the longer amortization. That's what's favorable with the COPs versus a bank loan. And secondly, that you've got, you were going to start spending the money right away because the existing bond proceeds you had on hand were almost spent completely, and you needed to continue to fund these projects. So you were going to spend the money right away. That was our understanding. Heather, is that fair? Okay.
That is based on the projects that are in the pipeline per Garrett. That is correct.
So what I'm really hearing is that in about 2 months, if we don't go forward with this, and we don't get a short-term loan, the tractors and everything stops.
Well, I'm hearing that if we don't get additional cash somehow.
Yes, if we don't get it, if we don't come up with some form of funding here.
But I'm still, this is where those cash flow things are really important. The history that we've had here is that we take out the loan and it sits in a bank account. We're paying, and nothing's happening. So I'm hearing that we're not going to be in that completely in that state. But I think that's something that we probably want to bring to the board as a unified package of, folks, here's where we are with all of these projects we're working on. We're in these phases. This is when we think the money's going to hit by month or quarter, however it works. And this is the financing that we need. And rolling that into the, the operating and the operating margin and non-operating revenue that we get, which totals about $4.5 million a year, roughly around that right now. The key thing for me, and one of the other concerns I had about backloading the debt there, is that we need to be spending about 5 million a year, every year, just to stay current with our infrastructure. Our total infrastructure runs about 400 million. And if you line up all of the lifespans of all the assets and you come up with a number, it's about 5 to 6 million a year. So
I think that's fair.
let's just say
Yeah.
5.
That's fair.
I've got the spreadsheet to back it up if we
Yeah.
wanted to show it. We're going to need to take out, in my opinion, loans about every 3 to 4 years in about 15 to 20 million dollars in order to stay current with capital improvement. In order to do that, we need to have operating margin plus non-operating revenue equal about 750 to $1 million per 15 million taken out. That seems to be about what we're looking at. My concern here about where we're going with this is that if we backload too much, we're then going to start impacting our ability to do another loan in 2027, which is probably the next time we're going to need to do that. Maybe sooner if this loan can't be 15 million, it's more like, 10 or 12 or something like that. So when I see those numbers, I figured that's what you were doing. When I see that start getting backloaded, I'm like, all we're doing is pushing the issue off into the future where we're going to affect the next loan.
However, if you amortize principal more quickly, particularly in those early years when you have existing obligations, it downsizes considerably the amount of money that you can borrow because again, we're restricted to that 125 rate cover.
Yeah, I get that. And this is where for me, the trade-off is. So it might be better if we're going to go to the market now with long-term financing opposed to a shorter-term, more bridge-oriented thing. Because I am anticipating interest rates are going to be better next year. You may not agree with that, but that's my...
That seems to be the general consensus.
Yeah,
if I could predict it, I'd be a very wealthy man.
and same with me, but based on what I've seen, it looks to me like interest rates are going to come down.
Mhm.
So what is it that we really need now in order to maintain a reasonable principal amortization, and maybe it's not even 12 million, and keep the projects going. And then after the first of the year, we come back and say, okay, now we have clarity around the election. Maybe we'll have some clarity around where the market's going to go on interest. Are we then taking out like a $15 million loan at that time in order to be able to fund the projects that are in the pipeline, combined with perhaps additional clarity around what FEMA reimbursements are going to look like? I don't anticipate inflation continuing to be as big of an issue. In a high inflation world, pushing those out would actually be good.
Yes.
But I don't think we're going to be there. So I'd rather not. I'd rather take a more conservative approach on our amortization and make the loan fit what we can do, keep the projects going, wait for the election, wait for interest rates, and then go back out with a bigger approach. That may then move us more to a short-term type situation. So anyway, that's it
In
is
an
a
ideal world, that sounds very good. Whether we could implement that, I don't know.
well, either of these things, it didn't take us very long to get bank financing. Now, again, it was a different environment. I haven't reached out to my, Muni friends to say, hey, what is the situation here with banks and all that? But it needs to be part of the conversation. And it certainly needs to be backed up by what our cash flow and capital improvement plans are going to be. Because at the end of the day, I want to give Brian and staff as much money as we possibly can do to do capital improvements. We are way behind as an organization. We need to catch up. We need to do the 75 million that was in that plan. We need to do the FEMA. We need to be shifting as much money from operating the capital as we can. I just don't know this is the best way to do it right now.
Are there any further comments?
I just wanted to make a clarification.
Please.
To me. And perhaps you can comment. We are allowed to invest this money, correct?
You are, but you are restricted as to the amount of money. So it's based upon what's called the arbitrage yield on the bond. So let's say that arbitrage yield is 4%. You can earn 4% interest on that money. If you earn anything above that, you have to rebate it to the federal government. So the idea is not to hold the money and make money on it. The feds don't like that.
I understand. And we are
But
allowed,
that does reduce the cost.
It does reduce the cost. It is offsetting the cost somewhat.
Yes.
because as I recall, our initial discussions were, if it were not for this ballot initiative, we knew we had the pipeline for 19 million, and it would have cost us less to get the 19 million than to get that all in one shebang rather than in two helpings. And as it is now, we are waiting for at least 7 million. The financing will come after the election, if at all. It may not come at all because the election may prove we won't have any more borrowing power, or we can borrow the rest later. But we did pretty much add up. I mean, in terms of cash, it's like we have considerable projects: Forest Springs, Brackenbray, Peavine, this tank project that we're doing right there. There's $6 million. That's half of it. So we went through a lot of iterations on all this. We went through the short-term loan scenarios, and we just determined that it's like we're better off borrowing for a longer haul for the near term year or so's worth of projects that were in the foreseeable future. So I'm very confident in the next 12 months or so we will burn through most, if not all, of this money. And it could be, maybe it's 15 months, but it's very small difference. So, but I did want to point out the bit about investing it. There is that possibility. You can't just put it into, you can put it in the bank, so to speak, and at least get nearly, 4.5%, and we're fine. Right.
Yeah. Give me a second. Director Fultz.
Historically, things may be different now, but historically, we haven't had quite that success. There's usually been a 1 to 1.5 delta between our cost and what we'd actually get from that.
Yeah.
Not saying it's not a consideration, but I think it's something that I still want to see projects where we are, et cetera. For the tanks, for example, I get it, 6 million in grant funding, 1.5 million for us. But we're just starting the design phase in that. Historically, that's been about a year process. Can it get done faster? Maybe. But historically, it's not been that fast, especially with the number of tanks we're talking about replacing.
So I would also comment that if you go back over the last couple of years, when we hadn't been spending some of this money as fast as we probably should have, it's also fair to say that we had a fair amount of turmoil in financial leadership. We're on our third director of finance in the last 2 years here, so I'm not sure that the store was being watched as closely as it needed to be.
Well,
in terms of taking proactive moves to reinvest the money and things like that. I'm not sure a lot of that.
Oh no, I think both Stephanie and Kendra were on top of that. They may not have made the right selection of investment.
Yes.
But the money was being reinvested. But we did not get to the point where we're making a profit.
Well, and you can't.
And I know you can't do it. Right? So,
No, we didn't.
we didn't even have that happy possibility.
Yes.
Right? So,
yeah, I'm just saying that there was some turnover, and that always results in some disruption in getting things done.
yeah, we still don't have full time, right? And probably won't until other things have clarified.
Yes.
And I can also, just from all the other water and city clients that I have that do water projects, is that almost every single project has been bid out, and you guys here have probably seen the same thing. They're coming in at 30% or greater than engineers' estimates, so it's significantly higher. That's inflation. they're having a lot of supply chain issues, even buying pumps for like wastewater treatment plants. They're having trouble finding the manufacturers. Some have gone out of business. There are just a lot of issues that have delayed projects. And COVID obviously was a big part of that. Then the supply chain stuff hit, and then inflation drove a lot of these projects. There's a lot of sticker shock out there. You guys are not the only ones that are realizing. So.
Well, and I think that's going to impact what actually gets done in the project in the time period that we're talking about here. Just again, I look at our historical capability, and it's no fault in anybody. It's just it takes time to do this stuff, and usually much more than you expect.
And I'd just like to make one comment. In my world, the only good predictor of the future is the past. You can say we've had turnover, you can say we had a fire, and that's all, maybe those are once in a lifetime issues, but unless the district can come up with a plan that says, okay, this is what we can do. These are the timelines, as Bob is talking about. This is what's realistic. This much time to bid, this much time to, unless we've got that level of granularity, I don't know that you can say that things are different just because we want them to be different. Having said that, I have to comment. Everyone I've dealt with in the district is aces. I mean, everybody. So I'm not bad mouthing anybody. I'm not at all. I'm just doing what I wanted to do, is play the part of the ratepayer and ask questions.
Okay, do we have any additional comments on this issue?
Let's hear from the community.
Please.
I'm trying to follow this between yesterday's meeting and then today's meeting by looking at both, as it obviously, I'm Nicole from Brackenbury. If this loan goes out, this means that no money can be borrowed for 5 years because this is a 5-year CIP. So for consolidation, it's not. What was mentioned yesterday was that project list doesn't show the larger, like $12 million cost for that project, and it was kind of hard to see what grant money was there and where are those priorities. Does that mean that consolidation is not moving forward beyond the phase 1 until that 5 years happens? I'm just trying to follow how that works. And then I heard Bob say something like, maybe it wasn't you, but there's a 14 million per year community continuing improvement project or whatever. I'm just trying to understand. I'm finding it hard to understand. Like, is this the last loan for the next 5 years to do
Not necessarily.
construction projects?
Not necessarily.
I think it only depends on what our capacity is to borrow.
Yeah.
So between operating margin and plus non-operating revenue, that equals X dollars, which right now is about 4.5 million, I think.
And FEMA reimbursements and such, which
Yeah, well, and that,
there's a cash flow there.
right. And so at least from an ongoing point of view, right now we can support probably what 4.5 million will support maybe around what $50 million total borrowing, something like that. So, and then you get the FEMA.
Yep.
But that's one time. You wouldn't put that into your ongoing thing. It would just be you take a loan out to deal with those issues, or the money just comes in. We don't need to borrow at all.
Yeah.
Keep in mind, we still have reserves we have to build up, right? And our reserve policy says we should be having about in cash that we can use for whatever we want, not debt financing. That's fake reserves. Real cash reserves, about 8.5 million. So that money that comes back from FEMA might just need to go into reserves. So at the end of the day, it really comes down to what our margins are, is how much we can borrow.
So Nicole, if I could comment, other than staff that doesn't get involved in the decision-making on this stuff, you, me, and Brian are the only ones in the room, and Mr. Holloway there, the only ones that were in the room yesterday for the engineering meeting. And I will guarantee you that the materials for this meeting have not been updated based on the recommendations we made yesterday about which projects and stretching out things and stuff like that. So
Okay, I understand that, but
Yeah.
the way in both committee agendas, it states the 3.9. Or this one only says 2 million. Yesterday said 3.9. The project itself is 12 million. I'm just trying to understand the timeline in which it happens, and I wasn't allowed to speak again yesterday, and I just I'm just trying to understand the plan and what limitations there are in regards to the consolidation. Because I think there's been a sense of urgency to get this out so that the other mutual feels like there's progress. And I'm just trying to understand, because we have money for Ackenbray.
We
It's gonna
understand
lose
that.
in August, that I'm trying to understand the completion, because our phase has not been scheduled. So
Okay, so
I'm just trying to understand
You're-
what
you're- you're-
limitations.
dealing with two committees that are not fully in sync on this yet, I don't think. And so there isn't necessarily an immediate answer to your question.
I just thought of this because you said two committees not in sync.
Yes. We haven't had time to sync up.
So we basically have, a week to try to sync up.
Yes.
I'm not sure if that's actually going to be possible. Hopefully it will be. But one of the things we might want to consider at the board meeting is having an ad hoc board group
Mhm.
get together and work on getting those synced up if they aren't synced up. And that would obviously be, driven by staff, but we'd be the ones that would be taking the feedback from both committees and putting it into a unified document. Because right now, I think that's really what I'm feeling, is we don't have that unified document to be able to say, yeah, this makes a lot of sense. Thumbs up, let's go.
Agree. So I actually think that's a very good idea. It will delay what decision we might want to make today a bit, but again, we aren't making the final decision here today. That's the board's decision on the first.
Yeah, I mean, we can still send it to the board
Yes.
with, either recommendation for that or no recommendation, whatever. We can do whatever we want. But I think it does need to be on the agenda on the first.
Yes, absolutely.
Yeah.
Okay. Does anyone have any further comments? Yes.
Just a real quick
Mr.
one.
Ho-
Sorry.
Go ahead, Mr. Holloway, and then you'll be next.
You seem like the hub of a hub and spoke serial meeting. You know what a serial meeting is?
Yes,
You're the hub of the hub and spoke serial meeting.
but it's all in public.
It's not a board meeting. The district is still in turmoil. The district has a part-time finance director. The district lost a key employee last month who's critical to making progress on projects that you're talking about. I don't think that's going to speed things up. People have been asking over and over again for cash flow, some kind of cash flow statement, something by quarters. I think I was asking a year ago, and I got told, that's it. That's our cash flow analysis. And my observation is that the money was going to take, if the district obtained Brian's dream loan, it wouldn't even be spent until 2028. That's what this shows. That was the original plan, was to borrow money now and not spend it until 2028. That's what this graph shows. I was here last week for this meeting, which didn't take place, and Mr. Deeker was here, so I didn't know who he was, but I kind of asked, why are we doing COPs when we haven't even spent the money from the COPs we borrowed 5 years ago? The 5-year anniversary on the 2019 COPs is August 1st, so it's been pretty much fully 5 years. Mr. Deeker said, oh, I heard you spent all that money by June 30th. And I kind of thought, why didn't the board get to hear that last week? Well, now I'm hearing maybe that wasn't even so. We still don't know if the money has been spent yet. And then the next thing I asked Mr. Deeker was, what's the consequence when you don't spend this kind of money for more than 3 years. There's some kind of a downside. I mean, if you issue municipal bonds and you spend all the money on capital projects within 3 years, I think there's a safe harbor under the Internal Revenue Code. And I've been trying to find out for 2 years, what is the consequence to the district not spending the money from those 2 loans in 3 years? And what Mr. Deeker said, well, as long as the district doesn't get audited, it's okay. And then at the meeting yesterday, Heather said the same thing. As long as we don't get audited, it's okay. I mean, maybe she can correct what she said. Maybe I misheard it, but this is a public agency. I think, we saw a new director take the oath of office and he swore to uphold the Constitution. Well, the Internal Revenue Code derives from the US Constitution. And I think we should at least understand if we're going to have to rebate money on the other 2 loans at some point. I mean, I guess we're going to find out next year sometime. Oh yeah, sorry, we had to pay $250,000 back to the IRS because we got too much interest or something. I guess I'm waiting and waiting. I've been waiting for 2 years for some straight talk about what are the consequences when you take out a municipal bond and you don't spend the money fast enough. Last fiscal year, the district started off with a $27 million capital plan. Now, I don't think the district came anywhere near that in fiscal 2024. And now I'm hearing 24 million. I can't tell if the 24 million is the last year plan or if it's this year's plan, but I guess a lot of the money that didn't get spent on last year's plan is rolled over into this year's plan. But I have no reason to believe that this year's plan is going to come true any more than last year's did. So we're not getting the kind of information. And I think the cash flow analysis is the key to it. So before I forget, I want to say, why not borrow $6 million? Just throw it out there. Just tell me why it has to be 12 million and not 6 million. One thing that keeps getting hammered over and over again is we got to spend that money to get we got to spend the 1.4 million that the board voted for last week to make sure that the grant money gets used by June of 2025. So 6 million would more than cover the 1.4 million you need for that project. So that would take care of that. But again, we don't know what these other projects are. We don't know the timing. Yet at the meeting yesterday, there was a chart that showed $5 million that the district had to spend for tank replacement. And then the discussion ensued, and it turns out that most of that money is being paid for by a state grant. And the state is apparently quicker at reimbursing districts than FEMA. So that ought to be built in to the next 12 months or whatever cash flow schedule. I mean, when I say cash flow, I'm not talking about a picture like this one that just shows how much money, the wish list of what you want to spend. I'm talking about when does the money come in and when does the money go out? Because we really are in a rolling situation where spend a little money, get a little back. Spend a little more money, get a little back. And it has to be laid out in a cash flow projection. There's no other way to be able to make decisions. I think I wrote down something that Jeff said yesterday. He said we can't make intelligent decisions unless we have better information. And as much as people ask, we never get better information. And I guess when you have a part-time finance director, that's the way it goes. We're still waiting for the June 30th capital spending results. How can we expect to have projections for the next few years when we can't even get June 30th time? So I guess I asked Scott to queue up one page, and I want to bring it up because there's something wrong on the memo. Can we put the page on the screen? So the page I asked for is from the audited financial statement from last year. And it's note 6 about long-term debt. So down there at the bottom, if you look at the column on the right, where it says long-term portion, that's actually the current balance today, because a couple columns over, you see balance 2023. So balance 2023 was on June 30th of 2023, but the whole fiscal 2024 has taken place, and that means that the new balance is the amount on the right column. Now there's a table in the memo that talks about these two loans, the CoBank one and the certificates of participation are a few lines down below. Anyway, the information in the memo is wrong. The correct information is here, and it shows that the current balance of the CoBank loan is roughly 13.2. That started out as 15 million, and we still haven't used it up yet. So that means that we've paid back. We've already paid back almost $2 million of that money that we borrowed, and it's still not spent yet. So in other words, we borrowed too much. We're borrowing money and actually paying it back before we're investing it in capital projects. And then the same thing for the certificates of participation. If you look at the memo actually says that the current balance of the COP, the 2019 COPs, is higher than it started out to begin with. That's what the box in the memo says. But here, this is the true figure. Between the premium and the indebtedness, we originally received something like 14.8 million, and the balance now is 13.7 something. So we paid back $1 million of that. So we paid back 2 million, almost 2 million of the CoBank loan already, and we paid back 1 million of the certificates of participation already. So that means of about $30 million that we borrowed about 5 years ago, we wind up paying back 3 million of it before we ever spent it. We borrowed too much, paid back the money, and paid interest for years on it too, by the way. How do we know that that's not happening here? The best way to know for sure is to borrow less. And so I'm suggesting, how about 6 million?
So, thank you, Mr. Holloway. We have one other person back there that wished to speak.
I just wanted to see Vaughn from Forest Springs. I just wanted to clarify a few things. First of all, I just wanted to confirm if phase 1 only was part of the 12 million. And I assume that in voting to go ahead with the consolidation, that we are committing to the entire project, that at some point phase 2, 3, 4, however many phases it will take, will be included and accounted for in terms of future funding. That's my first question. And I'm also still unclear on what first step has to happen not to lose funds or to officially start the project on the consolidation. What practical thing would be required, like specifically, and also what do we have all the players in place to commit to these top 8 priority projects? Specifically, do we have a new grant writer hired for the one recently lost, and are we hiring any additional staff? Thank you very much.
Thank you.
I'm gonna go ahead and answer that. Yeah. So I think the first part is, the question was asked, I believe, also by Nicole, is if we don't borrow at least 1.4 million, we will not have funds to go ahead with the first phase of this consolidation. So we need to borrow at least that much. But you were asking, maybe you can repeat, in terms of committing to the whole project, the district is still committed to that. But the funding is going to come in phases thereafter, whether we get grant money or whatever. To answer, do we have somebody to replace Carly for grant writing? We have 6 applicants right now, and 4 of them we're looking at, or there's a few that are worth interviewing. We're gonna wait a little bit longer, but we are definitely pedal to the metal hiring. So yes, I don't know, did I catch all your questions?
Yeah, no, most of them. And any additional staff beyond Carly's replacement? And again, what is the first step technically that will sort of officially launch the project?
Well, the first step is that we're putting that project now that if we get this funding, we will put it out to bid. And we are wrapping up the bid package so that we can actually have it ready to go, but we approve it in August, in a week and a day from now, then yes, we can go ahead and feel confident that we can put that out on the street for bids, because we'll have the funding to pay for that first phase. And then your other question was, are we gonna get another staff? We are looking at considering hiring an additional engineer and possibly even a grant type analyst or somebody that can help with a lot of the other issues we have at the district in terms of certainly grant writing, grant reporting. There's a lot of things like that our last person was doing. So we're looking at that. Of course, that is all subject to approval by the board. So I can't just go hire these people or create these positions without, but these are all things that are being considered, because we're also doing a salary study right now, which will then, how would I say, roll into actual negotiations and with the different labor categories we have here. There's management and classifieds. So all of that together, that's all employment, that's all in the works as well. So, I think I got it.
Great, yes, thank you very much.
You're welcome.
Director Fultz.
I want to make sure though that I'm clear on the question. In terms of funding future phases of the consolidation with Bracken Bray and Forest Springs, are you expecting that to come from sources other than grants and your pockets?
Yeah, I just want to make sure that we're in a later phase.
Because
we're not gonna hear, sorry, we're out of money and we can't find more.
because at least up until now, it's been the board policy that the consolidation can't be part of the existing SLVD community fiscal responsibility. So that is the current 8,000 subscribers that we have in our district are not going to pay for your consolidation. So when I hear the word whatever, I want to make sure that it's really clear that the whatever is not everybody else paying for anything more than staff time or, making grant applications or what have you. Right, because that's part of being good neighbors and moving the consolidation forward. But saying that the additional, whatever it is, $10 million that are required are going to be taken out of loans that the SLVWD takes out, that's not on the plate.
Right.
Okay.
No, yeah, I'm still not sure where all that is coming from, and I'm aware we can't dip into current ratepayers, and that would be illegal. And we expect as a community that our rates may need to go up to kind of absorb some of these increased costs as they already have, but in order to fund future projects. So, and hopefully it will go back down, but usually when something goes up, it doesn't come back down. So I'm just wondering where all this.
No, I get it. And by the way, it's not illegal, but it's a policy that the board has, at least up until now, taken on. And that was sort of a result of prior consolidations that were done in which fiscal responsibility for shortfalls and other infrastructure got put on the backs of the existing ratepayers, and that wasn't really part of the deal, right? And so there's some sensitivity around that.
So I would comment that I believe that is also now DWR policy.
Yeah.
So, and so it's state government policy also now.
What state government?
the policy that says existing ratepayers of the district can't fund
Okay.
a consolidation directly.
Would you mind, Mr. Hill, if I restate my question, because I know my question wasn't really fully answered. And
Okay,
it's nice that Forest Springs questions get answered, but I guess what I would like to see an understanding is that there's 3 divisions to how this would be funded if there's no grant money.
Right.
Forest Springs pays, Brackenbury pays, and then there is, when you look at this sheet, which originally just shot up Big Basin Way, existing SLV,
Mhm.
all that infrastructure that's 2 inches and 4 inches would be the responsibility of SLV to be responsible for, except for the missing infrastructure to create those connections. And what's happened with this first phase is we're off into this neighborhood addressing infrastructure. And so if I'm just trying to understand this loan that you're going out for, does that prevent SLV participating in their cost share? If this is a 5-year
Okay, so
loan,
I'm not familiar with that map you're showing or the phases you're talking about. So I'm not sure we can actually comment on that.
But Jeff, this gets into, I think, the questions that both the Forest Springs people have and Bracken Prairie have, gets into the need for the study session that we've requested on multiple times over the last few months. Until we have that, where we can have more of a back and forth conversation, make sure we understand what the issues are. I understand we may not have all the answers, but I at least want to get all the questions and all the possibilities out on the table so we can have that conversation and pursue those answers. And until we have that, I don't know how we even get to where we can address the questions they have.
Well, I certainly don't know the questions well enough.
I think Brian had a comment.
I just wanted to get back to the topic at hand here, which is this water revenue certificate. The only answer I have again for Brackenbury's question is, yes, the first phase would not, the money that we asked at the last board meeting to commit, the district commit 1.4 million to that first phase of the project. If we do not borrow at least 1.4 million, we will not be able to implement that project. So I just want to make that clear. I did say that to Forest Springs as well when she answered. It's the same thing. The rest of it is topic for another. Obviously, it's way out of the realm of this discussion. So I'd like to bring it back. I mean, if I can, we have one of the experts here in financing. We also have our finance person online. The questions about the loan itself and the structuring and some of the details of that, because that's what we'd like to vet here rather than going to the board meeting and then having that same having that discussion there, if we can have a more constructive input at this level.
Director Fultz.
Well,
I'm not sure I got
the president, could you?
I'm not sure that I got recognized, interim general manager. I'm not sure that I got an answer to my question. I'm not sure I got an answer.
My question, say yes.
I'm not sure I got an answer to the question about did we pursue and what options were there for bank financing as opposed to COPs, which had more flexibility, a little less overhead, et cetera.
Okay, I'm not sure we have that either. Mr. Fruss, you were trying to ask a question.
Well, my question was, can we get back to the topic at hand and could we please, we have this person, may we do that? And since as the chair, I'm asking you to respond to it.
And amazingly enough, he recognized me and I answered a question exactly on that point. So with respect to bank financing, what options are there out there?
Well, like I said, a lot of commercial banks have left the public finance arena. There are some still operating. You're right, it is for a shorter term financing or smaller financing, generally bank private placement, call them direct placements, are more efficient than going to the public market. But given the size of this financing and the 30-year term, we ultimately ended up with this scenario. Yes, we did talk about short-term, not short-term financing as much as we talked about direct placement financing, or what you generally call private placements with the commercial banks. and it wasn't as efficient, and part of it was the fact that we had to amortize it in so much a shorter period. However, if you downsize the transaction to a much smaller size, it may be more attractive that we could amortize it over a shorter period of time to still maintain the rate covenant. That's the concern, right? Particularly with that ballot measure hanging out there, not knowing what impact that's going to have.
So there are banks that would do a private placement of, let's say, 6 million, 4 million, whatever, over a 15 or 20-year period?
Probably not 20, most likely 15.
Yeah. Okay.
I
So a
think
little
there's
shorter
one
than,
out there that I think Capital One may go to 20, but it's only for certain credits for water bonds. So again, it will have to, we can sample the market on that and get back to you on that if that's something that this committee wishes to explore.
okay, so there hasn't been any sampling of that done yet.
No, it was done early on back in, I want to say April when we first started down this road, but we needed 19 million and we realized that we had to amortize it over a much longer period of time. And then of course that got downsized to 12 million. Still needed to be amortized, trying to maximize the amount of borrowing capacity because you had CIP and you complete. That was the direction that we received, which is the way the financing teams work with all these documents and everything else. So that's where we stand.
Well, I definitely would like to see something, at least some level. How long does it take you to sample? Is it a few days? Is it weeks?
days,
Is it
yeah.
a few days? Yeah.
I mean, it's really just comes down to what is their interest rate and what is their redemption provisions for their obligation.
I'm assuming that most of these would have a call limitation for at least half, if not 2/3 of the.
Yeah, usually
period.
it can be as short as any date. It could be, 5 years, 7 years. I mean, obviously the standard for municipal bonds is a 10-year.
10 years.
Yeah, 10-year call. Correct. But like I said, we ruled it out early on only because we were given certain parameters to try to maximize the amount of proceeds because you guys needed to fund these projects. And the only way we could do that was a larger transaction over 30 years to maximize the proceeds.
Yeah.
That was our sort of limiting factor.
Okay, it seems to me that we have basically two options in front of us. I mean, there's always the option of doing nothing, but that's not really an option. We do have to do something. And it seems to me we have two options, one of which is to take short-term bank financing to the point where to cover us until we know what happens in the election and whether our rate increase stands or gets changed. At which point we could then go out for a longer term bond issue. The other option is to proceed with the bond issue that we have proposed in front of us here.
I will tell you, for the city of St. Helena, I went through a short-term borrowing through the direct placement market to the commercial banks. And there weren't a lot of banks that were interested in doing that for a very short term.
Okay.
So for a bank financing, so what I've done in a couple of instances, we issued bond anticipation notes, publicly offered bonds that had, say, a 3-year maturity, could be callable as early as a year. But again, interest rates are so high on the short end of the yield curve right now that you're talking about 4.5% rates, if not higher, because it's a short-term obligation. So we're running into some things that have happened in the marketplace over the last 3 or 4 or 5 years since COVID, since inflation hit. A lot of banks got hammered in their portfolios. Interest rates rose. That's part of the reason they pulled out of the business.
So there are serious trade-offs between those two.
That is correct.
But that seems to be the two choices we are staring at the moment, as far as I can see. I mean, doing nothing is not an acceptable option, and
I do want to say though, we have done smaller financing in the past at a period of time where there was similar turmoil and the board's reluctance to commit to anything bigger, and that was back in the I think it was 2018 time period. Yeah, 2018, when a loan was taken out specifically for the probation tank. And in that time period, there was, the lawsuit, there was turmoil on the board, turmoil in the district in terms of the district manager. It was a real messy time. Took out a shorter term loan just to keep something going, to keep the process going without saying, okay, we're making a big commitment. The following year, when things stabilize a little bit, that's when the bigger commitment was going to be made. Also during 2018, they were pursuing a 40-year loan through the Department of Agriculture, USDA. A friggin' nightmare of a loan, and thank God we didn't go down that path in terms of the overhead and bureaucracy. But there was just a lot of turmoil, and so the short-term loan made a lot of sense at that point. Actually, not short-term loan, smaller loan, but I think it was a 15-year. I think it was a 15-year loan, something like that.
So it would not be practical, is my understanding, to do a short-term loan that was literally until like the end of the year when we would know.
No, that would be more in the realm of whether you're a commercial bank that you deal with, we're willing to
Yeah.
do that with you.
Yes.
It's not something that the public finance banks that do
Yes.
bonds for their own portfolio are really not that interested in these short-term obligations.
Yes.
So that's concerning, but there could be a line of credit or other opportunity to get that short-term financing through your commercial bank. Or like I said, we could go and do a bond anticipation note that we maybe have a 2-year maturity callable in as much as short as a year. But again, that's a publicly offered note where you're going to pay a pretty high interest rate.
Yeah.
My concern is that you're borrowing in short of yield curve, which is really high right now because we have an
Yes.
inverted yield curve, right? 5% rates up here, down to 4, back up to 5. I mean, you've got this really weird yield curve right now. But I have, just so you know, I don't know if you guys are aware of this, I am a municipal advisor and I have a fiduciary duty to the district to provide you with my best advice. So I am your advocate here on whatever the committee and ultimately the board wishes to pursue. So just so you're aware of what my role is on all of this.
Yeah.
Director Fultz.
Normally, inverted yield curves highlight a recession coming. So that may or may not be the case here. I did have a question for probably Brian or Heather, and that is, did we pursue any short-term financing possibilities with our existing banking, Wells Fargo, for example?
Not to my knowledge.
Okay, great, thank you.
Ken, but remind me, we did have these discussions about the short-term loan. And one of the issues was if we borrowed less money, we would pay a higher interest rate and it would be a shorter term, which means that in terms of being able to debt service, we're actually limiting our ability to serve more debt.
See, and that's the concern about having the shorter term bank loans in that 15-year range, is that you're compressing the amortization, just like a 15-year mortgage versus a 30. And what we're trying to do here is to do two things. One, maximize the bonding capacity the district currently has while maintaining the rate covenant that you're required under your legal provisions, as well as allowing room for additional borrowing, because debt service, once your existing parity obligations drop off, you've got a much lower amount of debt service that allows you to layer in additional principal on future finances. So I understand that you don't want to stick that out for 30 years, but what I'm saying is that if you look at the global picture, it does allow you additional capacity. If you amortize something over 20 years, for example, then you've got a much higher debt service you have to layer around when you do another further financing down the road. That's also part of what we tried to accomplish here.
So I guess what I'm dovetailing on here is the point I'm trying to make is we did go through a number of scenarios enough to me at a high level to realize short-term financing is not really in our best interests, my understanding. And again, we do have enough projects to justify borrowing the 12 million. I mean, if we could have borrowed the 19 million, we would have done that as well, because for this foreseeable future, that's probably 2 years, maybe 2.5. But we can invest the money. And so what I'm saying is this was something that took a lot of hours in the making. We eliminated a lot of different possibilities and options, etc. We really want to go for this whole bit because yes, we can still go turn around and borrow another 7 million later. If this initiative doesn't pass, but right now we have plenty of pipeline. I mean, as you saw that we had listed $26 million in projects here, and I realize there's a little bit, we needed to sync up the two reports a little better. I didn't check the details on this one so well, but the NE committee did have the CIP list from yesterday. That's going to be presented to the board as well. But indeed, really at this point, what I'm hoping for and had hoped for is that we're really commenting on the structure of the loan and so forth, because we want to present it next Thursday. And if there's any questions about the actual structuring of it and what we're doing here, now's the time to answer them and give us a week, which is barely enough time to work out some of these details. But I would prefer that we don't go chasing down some rabbit hole that's immaterial at this point. I think we've eliminated all the different possibilities, and we've come on this path, but this is the path that the district wants to take. I wouldn't have brought this to this point if I didn't feel that to be the case.
So I think we've heard pretty much the whole story here. And that means I'm going to ask if we have a motion in front of us for the committee to make a recommendation. And we may want to do two motions, but let's do them one at a time. So, and I think for simplicity's sake, I don't think we need a tremendous amount of detail in the motions, other than, are we looking at doing the originally proposed 30-year loan, or are we looking at doing a short-term followed by a longer-term loan at a later date? And I think it boils down to those two options at this point. So,
Jeff, I don't even have enough information here to even be able to say. I mean, the fact that we don't have this cash flow statement that had been apparently requested by multiple people. Let me put it this way. I do not want to do what we did twice in the past, right? There's a word for doing the same thing over again and expecting different results. I'm not going to do that. At least I can't support that at this time. So, I mean, I'm happy to have this go to the board, but I can't vote to recommend what is in here that just goes like that. I can't do that.
Mr. Bond.
My question is we have a short-term issue that we need money to take care of the matching, and when is that date and how much money do we need? Because it seems to me like at the very least, we should recommend that funding if we don't do anything else. Is that the 2 million or the 1.4?
Right, but I like I said, what I was trying to point out is that we really would prefer that we don't do any short-term financing, because it's more expensive for us to borrow that, and then it limits our ability for, let's say you borrow $1 million short-term on your term shorter, you're going to end up paying a higher amount, or payments are higher, so now you're limiting. So that really, it's like borrowing $1.5 million on a longer term scale. Or
so I want to clarify something here. So I think what Mr. Foltz was referring to was a short-term like liquidity facility where there was like a year or 18 months of financing that allow you to keep the projects moving, which would ultimately be taken out, versus a direct placement with the bank, which would be like a normal bond issue, just amortized over 15 years at a fixed rate. So there's a difference between, so I just want to be clear.
Yeah, absolutely correct.
Yes.
And I will point out also, that you have a recommended motion in the memo that you can recommend this to the board to take it up. And I will point out that is a larger, more comprehensive, it's the entire loan package.
Yes.
This is business and finance, so we wanted to bring up the issue and get input from you on that first. We have the input from engineering and environmental on the project list. And so those combined plus other loan details that we don't have even in this report. Because this, we wanted it to be a high level, to just get the flavor of this is what we're planning to do, this is what we're planning to go ahead with, or proposing to go ahead with, as I should say. And then we have, and so basically, you will get a more detailed, of course, report at the August 1st meeting.
Could I propose a motion?
Director Fultz.
With the interim general manager's clarification there, the budget and finance, I move that the budget and finance committee recommend that the interim general manager place the need for debt issuance on the August 1st board agenda for approval.
Do we have a
Then I'll
second?
second it.
We have a motion. We have a second. Do we
Just
have,
for clarification, just so I understand. So that meaning that you wouldn't want to see the bond documents, everything, there's gonna be more a need for the financing versus like bringing the entire loan package to the board. We need to know as a financing team how you guys want to pursue that, so I just want to give some clarification.
It is deliberately crafted to be open-ended around potential for liquidity, short-term liquidity, long-term debt. It's deliberately open-ended.
That's what I seconded.
yes, and I think that means that you should be prepared. Do we have any other comments from the board, or from the committee or the public? Seeing none, please call the roll.
Jeff Hill,
Yes,
Bob Foltz.
Yes.
Jim Bond.
Yes.
All right.
having no other business on the agenda at this point, this meeting is adjourned.
Great meeting.
Pardon?
Great meeting.